Money market and capital market in India, Part 5. Second, lack of uniformity in the rates of interest. The money market comprises of various entities such as commercial banks, cooperative banks, non-bank finance companies, development finance, institutions, investment companies, etc. The category of borrowers is also different. Third, shortage of funds. Money market faces shortage of funds due to inadequate savings, low per capita income, poor banking habits among the people, indulgence in wasteful consumption, inadequate banking facilities in the rural areas, etc., have also been responsible for the paucity of funds in the money market. Fourth, seasonal fluctuations. Demand for funds varies as per the seasons. During the peak season from October to June, finance is required on a large scale for various purposes such as trading in agricultural produce, investment in business activities, etc. This results in wide fluctuations in the money market. Fifth, lack of financial inclusion. Banking facilities in the country are still inadequate and inaccessible to the vulnerable groups, such as the weaker sections and the low income groups. This shows lack of financial inclusion. Sixth, delays in technological upgradation. Use of advanced technology is a prerequisite for the development and smooth functioning of financial markets. Delays in upgradation of technology hampers the working of the money market. Reforms introduced in the money market. Following are some of the important reforms introduced in the money market. First, introduction of new instruments such as treasury bills of varying maturity periods, commercial papers, certificate of deposits, and money market mutual funds. Second, RBI repos and reverse repos were introduced under the liquidity adjustment facility. Third, interest rates to be largely determined by market forces. Fourth, National Electronic Fund Transfer (NEFT) and real-time gross settlement were introduced as an improved payment infrastructure. Fifth, electronic dealing system was introduced by bring about technological upgradation. Do you know recent developments in banking sector? Small finance bank. Small finance banks aim to promote financial inclusion through supply of credit to small business units, small and marginal farmers, micro and small industries, and other unorganized sector entities through high technology but low cost operations. Second, payment banks. A payment bank is like any other bank but operating on a smaller scale without involving any credit risk. In simple words, it can carry out most banking operations but can't advance loans or issue credit cards. It can accept demand deposit up to Rs 1 lakh, offer remittance services, mobile payments, transfers, purchases, and other banking services like ATM/debit cards, net banking, and third-party fund transfer. Universal banks. Universal banks refer to those banks that offer a wide range of financial services such as commercial banking and investment banking and other activities, especially insurance. It is a multi-purpose and multifunctional financial supermarket providing both banking and financial services through a single window. Local Area Bank. Local Area Bank scheme was introduced in August 1996 to enable mobilization of rural savings by local institutions, especially private local banks, and make them available for investments in the local areas. This helps to bridge the gap in credit availability and strengthen the institutional credit framework in rural and semi-urban areas. B. Capital market in India. Meaning, capital market is a market for long-term funds, both equity and debt, raised within and outside the country. It is also an important constituent of the financial system. Development of an effective capital market is necessary for promoting more investments as well as achieving economic growth. The demand for long-term funds comes from agriculture, trade, and industry. Individual savers, corporate savings, banks, insurance companies, Specialized financial institutions are the supplier of long-term funds. Structure of capital market in India. The capital market in India comprises of the gilt-edged or the government securities market, industrial securities market, development financial institutions and financial intermediaries. Figure 9.5 explains the structure of India's capital market. First, government securities market. It is also known as the gilt-edged market. It deals in government and semi-government securities. Such securities carry a fixed rate of interest. Second, industrial securities market. It deals with the shares and debentures issued by old and new companies. It is further divided into primary market and secondary market. Primary market helps to raise fresh capital through sale of shares and debentures. Secondary market deals with securities already issued by companies. Secondary markets function through stock exchanges. Stock exchange is an important constituent of the capital market. It is an association or organization in which stocks, bonds, commodities, etc. are traded. Bombay Stock Exchange and National Stock Exchange are the premier stock exchanges in the country. Third, development financial institutions. They provide medium-term and long-term financial assistance to the private sector. They include Industrial Finance Corporation of India, Industrial Investment Bank of India, EXIM Bank, etc. Fourth, financial intermediaries. Financial intermediary is an organization which acts as a link between the investor and the borrower to meet the financial objective of both the parties. They consist of merchant banks, mutual funds, leasing companies, venture capital companies, etc.